A lender reached out to me about refinancing my FHA loan. And at first, it sounded like a no-brainer. My current rate was around 6.49%. The new rate was around 5.75%. So obviously, my first thought was lower rate equals lower payment. Why wouldn't I do this? But then I actually ran the numbers. And that's when I realized something most homeowners miss. A lower payment does not automatically mean you're saving money. Sometimes refinancing is a smart move, but sometimes you're paying thousands of dollars just to make the monthly payment look better. So I'm going to walk you through the simple math using my own real life example. Just 4 questions. Step 1, how much are you actually saving per month? Start with the basic payment difference. My loan balance was around $278,000. At 6.49%, the principal and interest payment was about $1,755 per month. At 5.75%, the principal and interest payment would be about $1,622 per month. So the math is simple. 1755 minus 1622 equals 133. That means the refinance would save me about 133 per month on principal and interest. That's the first number you need. Old payment minus new payment equals monthly savings. In my case, that number was about 133 per month. Step 2, what does it cost to get the savings? That's where people mess up. They hear, you're saving 133 a month, and they immediately think, great, I'm saving money now. But not yet. Because now you have to ask, what am I paying to get that 133 per month savings? With an FHA streamlined refinance, the word streamline sounds like it means free, but it doesn't. Streamline basically means the process may be easier and require less documentation. It does not mean there are no costs. And with FHA, one of the big costs is something called UFMIP. That stands for Upfront Mortgage Insurance Premium. In simple terms, it's an FHA fee charged upfront when you take out a new FHA loan. The standard FHA upfront MIP is usually 1.75% of the base loan amount. So on a loan around $278,000, that would be 278 times 1.75 equals about $4,865. Now, that sounds terrible. But with an FHA to FHA refinance, you may get a credit from the upfront MIP you already paid on your original FHA loan. So in my case, after estimating the credit from my old FHA loan, the real net upfront MIP cost may be closer to around $2,000, not the full $4,800. That's a huge difference, but it's still a cost, and that is the point. Even if you don't bring that money to closing, it may still be added into the new loan. So don't only ask, what is my cash to close? Ask, what is the true cost of the refinance? That means lender fees, origination fees, discount points, title or settlement fees, new upfront MIP, minus any FHA MIP credits, minus any lender credits. That gives you the real cost. In my example, let's keep it simple and say the true cost is around $2,000. Step 3, what is the break-even point? Now, this is the most important part. The break-even point tells you how long it takes before the refinance actually pays for itself. The formula is simple. True refinance cost divided by monthly savings. In my example, the refinance saves about $133 per month. The true cost is around $2,000. So $2,000 divided by 133 equals about 15 months. That means it would take me about 15 months just to break even. For the first 15 months, I'm not really ahead. I'm just recovering the cost of doing the refinance. After that, the savings actually start to matter. And this is where the decision gets clearer. If I know I'm keeping the house and keeping the loan for several years, a 15-month break even might be fine. But if I might sell the house, refinance again, move, or change my plan before then, it may not be worth it. Because if I refinance today, but sell the house 10 months from now, I didn't really win. I lowered my payment, but I didn't keep the loan long enough to recover the cost. That's the trap. The lender may be focused on the lower payment, but you need to be focused on the break-even point. Step 4, are you restarting the loan clock? There's one more thing people forget. When you refinance, you may be starting over with a brand new 30-year loan. That matters. Let's say you bought the house a year ago. You started with a 30-year mortgage. Now you have about 29 years left. If you refinance into a new 30-year loan, your payment may go down partially because the rate is lower, but also because you stretched the loan back out. That does not automatically make the refinance bad, but you need to understand what's happening. A lower payment can come from two places: a lower interest rate or a longer repayment period. Sometimes both. So before refinancing, ask the lender, what is my current remaining term? What is the new loan term? Is the amortization restarting at 30 years? And one of my favorite questions, what happens if I refinance but keep paying my old payment? Because sometimes that's powerful. You get the lower rate, but instead of spending the monthly savings, you keep paying the old amount. That extra money can go towards principal and help you pay the loan down much faster. But again, you need to see the math. So here's the simple refinance test. Before you refinance, ask 4 questions. Number 1, how much am I actually saving every month? Number 2, what is the true cost of the refinance? Number 3, what is my break-even point? And 4, am I restarting the loan clock? For me, the payment saving was about $133 per month. If the true cost is around $2,000, the break-even is about 15 months. That could make sense. But if the costs were much higher, if I didn't plan to keep the loan long enough, then the lower payment might not actually help me. And that's the lesson. Refinancing is not bad. An FHA streamlined refinance can absolutely make sense. But don't refinance just because someone shows you a lower monthly payment. Because the goal is not just to lower your payment, the goal is to actually save money. And those are not always the same thing. See you on the next one.